Today, we're diving into a story of incredible hype, a revolutionary idea, and a catastrophic collapse that absolutely rocked the crypto world. Okay, let's break down exactly what went wrong with the PIPPIN token.
So just imagine for a second, 66% of an asset's value just gone. For investors in the PIPPIN token, this wasn't some hypothetical nightmare. It was a very, very real and devastating reality.
And it happened unbelievably fast. We're talking about the span of a single weekend. The project's value was just gutted, leaving thousands of investors wondering what on earth just happened. So that's the big question here, isn't it? How did a project that seemed so promising, an AI token with so much buzz, just collapse in such a spectacular fashion? Well, that's what we're going to figure out today. We're going to peel back the layers on this digital mystery.
All right, let's start at the scene of the crime, so to speak. The exact moment the floor fell out from under one of the hottest tokens on the market.
I mean, the numbers here are just staggering. On March 17th, the price didn't just dip, it completely nosedived. Almost $200 million of market value just poof, vanished into thin air. For the people holding that token, it was an absolute bloodbath.
But, to really understand the fall, you first have to understand the climb. Why did so many people believe in PIPPIN? What was this incredible promise that fueled its absolutely meteoric rise?
See, PIPPIN wasn't your typical meme coin with just a funny dog on it. It was part of this whole new breed, the AI meme coin. The idea was to merge that viral, community-driven power of meme culture with genuine, cutting-edge AI technology. It was pitched as the best of both worlds.
And on the surface, this thing looked absolutely golden. You had a founder, Yohei Nakajima, who was a legitimate star in the AI world. The concept itself was captivating, an AI unicorn living on social media as a digital influencer. Plus, it promised real utility, real tools. And here's the kicker. It claimed a fair launch, which made it seem like a truly decentralized, community-first project.
And man, did the market respond. Just look at this journey, from less than a single cent to almost 90 cents in a matter of months. This wasn't just growth, it was an absolute explosion, fueled by hype, promise, and a whole lot of investor FOMO.
But here's the thing. While all that hype was very real, so were the warning signs. And for anyone who knew how to read the tea leaves of the crypto charts, the writing had been on the wall for months.
And it wasn't just hindsight. Check out this quote from the publication Be Crypto. They pointed out that this wasn't some random bolt from the blue. It was the predictable ending to a pattern that had been developing for a long, long time. The market was sending up flares.
So what were these clues? Well, the charts were practically screaming. First, there was a double top pattern. It literally looks like the letter M, and it's a classic sign that the price is about to fall off a cliff. Second, funding rates turned negative, which is basically the smart money placing huge bets that the price is going down. And finally, a metric called CDD spiked. Think of this like a dust alarm for old coins. When it goes off, it means long-time holders are moving their bags, almost always to sell.
Okay, so the charts tell us what was likely to happen, but they don't tell us who was behind it. For that, we need to go deeper. We need to use one of crypto's most powerful tools, on-chain analysis.
Think of it like being a financial detective. By looking directly at the public ledger of the blockchain, you can trace the flow of money, see exactly who holds the supply, and uncover patterns that are totally invisible on a simple price chart.
And this is what the analysis found. It's the smoking gun of the entire story. A truly staggering 80% of PIPPIN's total supply wasn't held by thousands of different community members. Nope, it was concentrated in a small cluster of wallets that were all closely linked to each other. And get this, at its peak, that 80% concentration was worth nearly $380 million, an immense amount of financial power held in just a few hands.
So here's the crucial point. That whole promise of a fair and decentralized project was, well, a mirage. In reality, a small coordinated group held a kill switch over the entire market. They could pull the plug whenever they wanted.
And on March 17th, that's exactly what they did. We have the motive, profit, and we have the means, control of the supply. Now let's look at the execution.
Now, this wasn't a spur-of-the-moment decision. Analysts had actually watched as over 50 of these connected wallets methodically bought up huge amounts of PIPPIN for weeks. It was a planned operation, executed right out in the open on the blockchain for anyone who knew where to look.
And it followed a simple, devastating three-step playbook. Step 1, quietly gain control of almost the entire supply.
Step 2, let the positive story and genuine hype attract everyday investors, who then push the price to astronomical levels. And then, Step 3, right when the price is at its peak, all those wallets sell at once, pulling the rug out and leaving everyone else holding worthless bags.
So what do we take away from all this? The story of Pippin is more than just a single token's collapse. It's a modern fable for the age of crypto with a really powerful lesson at its core.
You see, Pippin really had two faces. On one side, you have the promise, incredible technology, a visionary founder, a vibrant community. But on the other side, hidden just beneath the surface, was the peril. Extreme concentration of power, coordinated manipulation, and the ever-present risk of a massive dump.
And that leaves us with this final crucial question. The dream of crypto is decentralization, power in the hands of the many, not the few. But the story of Pippin shows just how easily that dream can be corrupted. It forces us to ask, in this new financial world we're all trying to build, what does decentralized truly mean, and how do we protect it?